SCHD goes through its annual reconstitution in March 2026, and based on current market data, some meaningful changes are likely on the way, changes that could directly affect your dividend income. I've reviewed the probable additions and removals, and honestly, a few of them are unexpected. If you already own SCHD or you're considering buying it, this is something you need to pay attention to. This isn't just routine stock shuffling. These adjustments could impact your monthly dividend payouts and shift the sectors your money is invested in. Stay with me, because I'm going to walk through what's changing, why it matters, and what you should consider doing next. Here's what we'll be going over today. First, I'll break down how SCHD's reconstitution process really works, because most investors don't understand the criteria that decide which stocks get added and which ones get removed. Next, I'll walk through the most likely changes using current dividend data, recent stock performance, and sector allocations. And finally, this is the key part. I'll explain how these adjustments could impact your actual dividend income, whether that means higher or lower payments, and what steps you may want to consider before March arrives. By the end of this video, you'll understand this reconstitution better than the vast majority of SCHD investors. Quick disclaimer before we dive in. This video is for educational purposes only and should not be taken as financial advice. I'm not a licensed financial advisor. The reconstitution insights I'm sharing are based on publicly available information and historical trends, but the final changes won't be officially confirmed until SCHD makes its announcement in March. Everyone's situation is different, so make sure you do your own research and speak with a qualified professional before making any investment decisions. How SCHD reconstitution works. Alright, let's begin by breaking down how this process actually works, because once you understand the rules, it becomes much easier to anticipate what's coming. SCHD follows the Dow Jones U.S. Dividend 100 Index, and each March, that index goes through a reconstitution using a very specific rule set. This isn't guesswork or randomness. There are clear requirements. First, a company must have a minimum of 10 straight years of dividend payments. No exceptions. That alone removes younger companies and any stock that reduced or paused dividends at any point over the last decade. That's why you'll never see high-growth tech names in SCHD, even if they've recently started paying dividends. Second, the company needs healthy cash flow relative to the dividends it pays. The focus here is sustainability, not just headline yield. If a business is paying out more than it earns, say 150% of earnings, that's a warning sign, and it won't qualify. Third, and this is where things get more interesting, they look at return on equity, or ROE. The goal is to include companies that are genuinely profitable with solid fundamentals, not just firms that happen to pay dividends. Fourth, dividend yield has to fall within a reasonable range. If a stock's yield sits in the bottom 25%, it's excluded. But if the yield is extremely high, around 10% or more, that's also a red flag, since it often points to underlying problems. All stocks that meet these criteria are ranked, and only the top 100 make it into the index. SCHD then holds those 100 stocks, weighted by market capitalization and dividend yield, until the next annual reconstitution. Here's the part many investors overlook. When a stock is removed from SCHD, the fund must sell millions of shares at the same time. And when a new stock is added, it has to buy millions of shares. That kind of activity can create short-term price moves, especially for smaller companies in the index. Once you understand this process, it becomes clear why certain stocks are likely on the chopping block, and which ones are strong candidates to be added. Based on current dividend data and stock performance through January 2026, here are the changes I'm expecting to see. Let's begin with the likely removals, the stocks that may be pushed out. The first group at risk includes energy companies with weak dividend coverage during 2025. Energy performed well early in the year, but conditions deteriorated in the second half as oil prices declined. If any energy holdings in SCHD reduced payouts or saw their cash flow coverage fall below required levels, they become vulnerable. Given the index rules, the energy sector is one I'm watching very closely. Second, certain financial stocks that significantly underperformed could be on the chopping block. SCHD has meaningful exposure to financials, but if return on equity dropped sharply for specific banks, or dividend coverage weakened, those names could be removed. Regional banks in particular faced added pressure in 2025, so smaller financial institutions may struggle to remain in the index. Third, any company that falls into the bottom 25% of dividend yield within the index is automatically at risk. If a stock's yield is well below peers and its overall performance wasn't strong enough to compensate, removal becomes likely. As for exactly which stocks will be cut, we won't know for sure until the official announcement. Historically, though, reconstitutions tend to remove around 10 to 15 stocks. Based on 2025 results, I'd expect most removals to come from energy and financials. Now let's shift to potential additions, the new names that could be brought in. Healthcare companies with strong dividend growth in 2025 stand out as top candidates. Several pharmaceutical firms raise dividends meaningfully and already meet the 10-year dividend history requirement. If they also pass the ROE and cash flow tests, they're well-positioned for inclusion. Industrials and consumer staples with improving dividend metrics could also be added, while some energy names may drop out. Technology remains limited due to dividend history requirements. If healthcare replaces part of the energy exposure, SCHD's sector balance would shift. Energy could decline from around 20% to roughly 17 to 18%, while healthcare could increase toward 18 to 19%. That change would affect diversification and overall portfolio risk. How this affects your dividend income. The big question is whether SCHD's reconstitution ends up increasing or reducing your dividend income. Historically, these adjustments tend to be neutral to slightly positive overall. In the short run, income depends on which stocks are removed and which ones are added. If a lower yield holding is replaced with a higher yield one, the fund's overall yield gets a small lift right away. For instance, swapping a stock yielding 2.5% for one yielding 4% gives portfolio income a modest boost. That said, dividend growth is far more important than the starting yield. Replacing a 3% yielder growing dividends at 2% with a 3.2% yielder growing at 8% improves long-term income potential, even if the immediate yield barely changes. Based on the most likely changes, healthcare additions often come with strong dividend growth, typically in the 6 to 10% range. Energy stocks, by contrast, tend to have uneven growth because of swings in commodity prices. So even if SCHD's current yield stays roughly the same, future income growth could improve. Let's put some numbers on it. With $100,000 invested at a 3.63% yield, you earn about $3,630 per year, or roughly $302 per month. If the yield edges up to 3.7%, monthly income increases to around $308. That's a small improvement now, but it compounds over time. If dividend growth rises from 8% to 10%, monthly income accelerates much faster. Within a few years, that gap can grow to $50 to $60 per month. Bottom line, short-term income changes are usually minor, but stronger dividend growth and better fundamentals can make a meaningful difference over the long run. So what should you actually do with all of this? First, don't panic, and don't sell ahead of the reconstitution. SCHD's methodology is designed to keep high-quality dividend payers, and the changes are typically upgrades, not downgrades. Historically, these reconstitutions have maintained, and in some cases even improved, performance in the year that follows. Second, if you're thinking about adding more SCHD, timing can matter a bit. Some investors prefer to wait until after the reconstitution, once the new holdings are finalized and any short-term volatility settles. Others choose to buy beforehand to capture current dividends. There's no single right answer, but personally, I prefer buying after the changes so I know exactly what I own. For a full breakdown of which stocks are most likely to be added or removed, along with detailed sector projections, I share that information exclusively with channel members. Members get in-depth videos, early access to content, my monthly updated SCHD tracking spreadsheet, and access to a private dividend-focused community. You can join using the link below. And finally, keep an eye on your sector exposure. If energy weighting declines, you may need to rebalance elsewhere in your portfolio. Fourth, and this is important, don't chase the stocks that get removed. A stock being dropped from SCHD doesn't automatically mean it's a bad company, but it does mean it no longer meets SCHD's quality standards. Unless you have a clear, independent reason to own it on its own, there are usually better opportunities elsewhere. Fifth, think about the tax impact if you're holding SCHD in a taxable account. The reconstitution happens inside the fund, so you're not taxed on SCHD's internal buying and selling. However, if the changes meaningfully affect your dividend income, that can influence your tax planning for 2026. For example, if your annual dividends rise by $500, that's roughly an extra $75 in taxes at a 15% qualified dividend rate. Finally, remember SCHD's long-term track record. Since 2011, it has raised dividends every single year through multiple reconstitutions. The system works. Trust the process. Quick recap. Potential removals are likely in energy and financials, with probable additions in healthcare and industrials. Short-term income changes should be modest, but improved dividend growth could add $50 to $100 per month by year 5. The official reconstitution will be announced in late February or early March. I'll be covering the confirmed changes once they're released, so make sure you're subscribed. What's your take on these possible adjustments? Are you holding SCHD through the reconstitution or waiting to buy afterward? Drop a comment and share your approach. Thanks for watching, and I'll see you in the next one.